everyone. We are live. My name is Chanel with Money of Chanel now, and today we have an exciting guest, Mariska from Mint Accounting. Welcome, Mariska. Why don't you tell us a bit about yourself and what you guys do at Mint Accounting?
Thank you, Chanel. So at Mint Accounting, we basically do everything from accounting. So we do the whole accounting function from bookkeeping to financial statements, independent reviews. So we can run a company's entire accounting function for them. We also do individual taxes for just normal South Africans who earn income and need to submit their annual taxes. And then, quite an exciting part of our business, I feel, is that we specialize in seizing residency. So, we help people who have left South Africa to inform SARS of the fact. And then also, we do tax advice. So, we can help people who have a complicated tax structure or who's maybe leaving the country and they need to pay a lot of capital gains tax. So we can help them with tax advice to reduce that basically.
Sure. That's about everything when it comes to tax. So, yeah, that's why I'm so privileged to have you here on the show. And I'm sure there's quite a lot of questions also from the listeners. So, if you guys have questions that you haven't sent to me, you can also drop it in the message box. And if we have time at the end, we'll also address those or we will incorporate those in the live. Otherwise, you can also mail them to me or Mariska. Mariska, your email address just before we start.
Okay, so it's mariska at mintaccounting.co.za and it's spelled Marisca at mint accounting, like mint that you eat. So, yeah.
Okay, awesome. Okay, so to start us off, why don't you tell us a bit about tax do's and don'ts that you've come across when working with clients and even businesses? So let's maybe start with tax do's.
Tax dues. Okay, so I would definitely say keep accurate record. I think something that's quite sad that people would come to us and say, I've started my own business this year and what do I do? And then it's the end of the year and they didn't keep track of any of their expenses. So it's just important to note that if you want to claim anything from your income, the burden of proof is on the taxpayer. So SARS is going to want to see the proof from you, and you need to be able to back that if you want to claim any expenses from SARS. So definitely keep anything. And my rule to this is always keep more, and we can then determine if anything is too much. But just keep everything. That's very important. Then I think this one probably goes without saying is submit your tax returns by the deadline to avoid any penalties and interest. So don't be late. And then understand your tax obligations. So this one actually still, there's a lot of people who don't, and they don't understand that if you earn anything other than a salary, that will be taxed as well. So it could be that you have anything maybe like, you've got a side business and it could be something small. If you're making something from home and you're selling that, that actually does attract tax. Or if you have interest in the bank or cryptocurrency, and you're trading a little bit on cryptocurrency, and even though it's not quite big yet, but that's definitely taxable. And if you earn rental income, that's definitely taxable. So, just my advice is to understand your tax obligations. And if you're unsure about anything, we at Mint do a free consultation. So, if you have any questions, you can just email us and we will help you to understand your obligations in terms of what you need to submit to SARS. Then I think a topic that a lot of people don't really understand well is provisional tax. So you need to register for provisional tax if you earn any income other than a salary. So if you earn a salary, obviously your employer is deducting your pay as you earn, and for that reason, you don't have to be a provisional taxpayer. But if you earn any of the other expenses that I just income that I just mentioned, such as rental income or interest or anything like that, and your profit is more than 30,000 Rand for the year, then you have to be a provisional taxpayer. And it's not an additional tax, it's almost like pay as you earn. So you're going to be submitting three tax returns a year. Provisional tax is submitted every year in August. That's your first provisional tax return. And then also in Feb is your second provisional tax return. So what you are saying to SARS in these returns is basically, for the first 6 months of the year, this was my freelance income or my crypto profit or my rental income profit. And I'm predicting for the 12 months it's going to be X. And for that reason, I'm paying this amount of tax. So we do a calculation for the full year. And then the second provisional tax return is submitted in Feb. So it runs for the full tax year. And it's also where you tell SARS then for the full year, I earned all of this income. We calculate the tax and then we deduct the tax that was paid in August, provisional tax period. And then you'll have a second provisional tax due. So then, as per normal, you'll have your normal tax return due for the year, and in this one you then declare your final income, final expenses for the year. And if you made any payments in your first and second provisional tax returns, then this would be deducted from the final tax return. So just make sure that you understand when you need to be registered for provisional tax and how all of that works.
Amazing. That's quite a lot of information. And I think not all of it will be applicable to everybody. So make sure to take the bits and pieces. This will be recorded, that is applicable to you. And I think just having that free consultation with Mariska helped me a lot. And I did a lot of research beforehand. So I definitely recommend. And then on the don't side, what do you suggest, or what are some don'ts when it comes to tax that you've picked up over the years?
Okay, so definitely don't wait until the last minute. And in terms of this, I mean, even if you do your own tax return, don't wait until the last minute. And very important, and I think I'm speaking here for all tax practitioners, don't wait until the last minute until you submit your documents to your tax practitioner as well, because it just puts everyone under pressure. And that's where mistakes happen and where you can actually miss the deadline. So try and get it in as soon as possible just to avoid the last minute scramble. Then also don't ignore any notices that you get from SARS. SARS will be emailing you or SMSing you. So once you get that, my advice is to log on to e-filing and go and get your actual notice on e-filing. SARS would email you to say that there's a notice on e-filing, and then you go get it there, because there is a lot of SARS scams going around where they would, pose to be SARS and send a letter via email to say that you need to pay X amount to SARS, and here's a link to make the payment. So then you click on the link and you actually put in your bank details, or you just make a payment to some random person, and they make it look so legit. They will take a SARS letterhead and type the whole thing. And I have so many clients sending this to me, and then it's shocking actually how bad it is. And they even have a SARS email address. I think the latest one that I got was from a government website, so I don't know how they got that right, but it was from a legit government domain name. So very important. SARS will never, ever, ever send you a notification to ask you to make a payment via email or via SMS. So they will always put it on e-filing. So then also another don't forget to inform SARS of your foreign income. So, as South Africans, we are taxed on our worldwide income. And for that reason, if you have foreign property or maybe foreign dividends, you must definitely declare all your foreign income to SARS as well. And if you paid any tax in the foreign country on that income, you won't pay double tax in South Africa. We do have a double tax agreement with most other countries. So, you can have a foreign tax credit available to you, but you have to, as a South African, declare all your income, and then you can claim exemptions and deductions from that income. So then another one, and this is a lot more for people not living in South Africa, could also be for people living in South Africa. So we have this 1.25 million Rand exemption available to us if we earn foreign income and if we spend time outside of South Africa while earning that foreign income. So a misconception that a lot of people do is they maybe left South Africa and they now live in a foreign country, maybe permanently, they're not going to come back, or maybe they are there for 5 years and they're saying, I might come back to South Africa after that. but my income is below 1.25 million rand, and for that reason I don't need to inform SARS that I'm not living in South Africa anymore. So I just want everyone to know that the 1.25 million rand exemption is available to you if you, for example, work offshore on the oil rigs, or maybe you work as flight crew, or maybe you go abroad for your company certain times of the year. That's when you can use the 1.25 million rand, but you still live in South Africa, so this is your home. But if you have moved permanently, then don't delay to inform SARS as well of ceasing your residency. And I understand that this is also such a like hot topic in the media, and there's a lot of fear mongering articles and a lot of misinformation, which is why a lot of people also don't do this process. So my advice is also just, if you have left the country permanently, definitely inform SARS that you've ceased residency, and we can help you with that as well.
Sure. Okay, that's quite a lot of yeah, different things that you guys can help with. I think especially with a lot of South Africans moving abroad or even working there temporarily and not knowing the rules, especially
Mhm.
working on boats, for example. That was quite a interesting one that I wasn't aware of, like how it worked. So, no, thank you for that. And then
Pleasure.
for the general public, how can we be more tax efficient, or and even for businesses pay less on tax? So what are some smart strategies to that we can do?
Yeah, so there's a lot that we can do. I feel actually, firstly, the most important thing is make sure that you have a registered tax practitioner who has a very good understanding of the income tax laws, because there's a lot of legal things that we can do to help people save tax and pay, and just like a lot of things that we can use in the Income Tax Act. So make sure that you know have someone who knows all of these tips and tricks. So firstly, if you earn a salary, there's not a lot that you can do. The only deductions that you really get from that is if you have a medical aid, and you can deduct that contributions, and also you get a credit for your medical aid. So that's something that can reduce your tax on your salary. And then also you get to deduct your retirement annuity contributions, or your pension contributions that can reduce your taxable income on your salary. Or you can make a donation to a registered NGO. They have to give you a Section 18A certificate, and then you can deduct that from tax. So you're quite limited when you only have a salary, unfortunately. But if you are a freelancer or sole proprietor, you can deduct your business expenses from your income. So that would be anything that it takes to basically run your business. So you get to deduct expenses. And then I would say don't keep any of your surplus cash in an interest bearing bank account. I think a lot of people feel like they've got access to this, but what that causes is that you earn interest income, and that interest income is subject to tax. So my advice would be to rather invest it either in a property, build up that and buy a property, or invest it in the stock exchange, where you will be paying capital gains tax on that only when you sell it in the future. So you do save quite a lot of tax, because interest income you pay tax on annually, and that's in your normal sliding scale. Whereas capital gains tax, you really pay that in the end, and it's much lower than your normal 18 to 45% sliding scale. Then a next one that I would advise is also, if you have built up quite a lot of wealth, or you are planning on setting up quite a lot of wealth, then definitely do succession planning, set up a structure for your wealth, and that would be in terms of a trust. So it's very important that you purchase all your assets, or you put all your assets in some way or form in the trust, so that the trust is the owner of that. And the reason for that is because when you pass away in the future, you will pay estate duty tax on your assets, and that's 20% up to 30 million rand wealth. And anything over 30 million rand wealth, you will pay 25% estate duty tax. So that's quite a lot that you're giving away of your assets when you pass away. And on top of that, you also need to pay capital gains tax on these assets that you own when you pass away. So it's important to do succession planning in terms of that. I recently had a client come to me, and he's built up a lot of wealth in his life, and he wants me to now do some planning for him on how to reduce this, but it's much too late because all of this is in his personal capacity. So helping him now with tax planning is still going to cost him 20% donations tax, or he needs to sell all his assets and put it in a trust. So you can't just take your personal assets, put it in a trust. That's a deemed sale, so you'll pay your 18% capital gains tax to get it in the trust. And also, if it's a property, there's transfer duty. So it's definitely just important to set up your wealth planning very early in your life. Then I would say quite a nice tip that I do like giving my individual clients who earn business income in their personal capacity. So if you're a sole proprietor with your business, I always advise people, depending on what your turnover is in the beginning stages of your sole proprietor life, I always advise clients to first do it in your personal capacity, because your income tax rate starts at 18%. And then obviously our sliding scale goes up all the way to 45%. So then, I mean, it's 18%, 21, 26%, 31%, and then we just go up. Where if you have a company, the company's flat rate is 27% that you pay tax on your profit. So the advice is always keep your income of your small business or your sole proprietor business in your personal capacity until you reach 26%, and then start doing planning. Because once you hit the next bracket of 31%, you're paying tax higher than you would in a company. So then it's necessary for you to register a company, and all your income goes through there. You run all your expenses and you pay tax on the profit. So it's at a lower rate. And then additional to that, you can also pay yourself a salary from this company. So you can also always do a bit of tax planning to see, how much salary should you take to pay the least amount of tax, which is a deduction in your company, which then again reduces the tax in the company as well. So if you're a sole proprietor, definitely look at your income. If you don't understand what the brackets are of when you start paying 31% tax, you can reach out to us and we can also help you with that.
So I have a question here for the deductions. When it comes to working from home, for example, the question is, can you also claim, for example, Wi-Fi or other expenses if you work, for example, 3 days from home in the week?
Okay, so this is quite a complicated topic. So let's first use this as you are a salaried employee, and you have an employer, and you go 2 days of the week you go to your employer's office, and 3 days you work from home. You can deduct home office expenses, and SARS is so strict on this. You have to have an office that is exclusively used for you working. So it has to be a room in your house that has a door that you can close, and there must be absolutely nothing in that room apart from your desk and your computer and your chair. Like, don't have anything else in there, because if you have a couch in there, SARS says no, you also use it for sitting. So this is not a home office. If you have a kitty and you put your kitty's table there to like sit by you while you work, no, you don't use this exclusively for work. So make sure that you don't even store your ironing board in that room. So it's literally just to work. It's very strict on that. So the way you then get to deduct these expenses is you would take the square meters of that room in your house, compared to the whole square meters of your house, and that would then create a ratio. So then whatever either your rent that you pay is, or the bond that you pay, the finance charges on the bond that you pay if you own this property, you get to deduct that ratio percentage of it. So it would be your bond or your rent. If you have a cleaner, if you pay electricity, telephone, if you pay Wi-Fi, basically anything it take in your house that it takes to run your house. Obviously not your DSTV and your Netflix, but anything that could be business related. So it could be your cleaner, because your cleaner comes and cleans your office as well. So anything related to you running your business from your home. And even if it's not your business, you're a salaried employer, you go work at your house, it's the same thing. So very strict with that. And then SARS would also ask your employer to write a letter to confirm that you work from home, and yeah, basically just confirm that. So they are very strict with that. The other part of that is that if you are a sole proprietor, you have your own business, then you do work from home. The same counts for how the office setup should be. It should be completely exclusive, all of that. But in this case, I would say that the Wi-Fi and your telephone cost, that should not be used as the ratio of the office, because obviously then you use your Wi-Fi more for work than you would for private. So generally what we would say is that we apportion your Wi-Fi cost and your cell phone cost at 80% business and 20% personal. And so I was generally happy with that. They don't want you to say, I use my cell phone 100% for work, because none of us do. So there just needs to be that apportionment, and then they will allow you to write off all that expenses.
Okay, I think that answers the question. And I think also when the person asked me this question, I wasn't sure how to answer it because it is so complicated.
Mhm.
And even at my home, I don't use this. I don't claim for tax because, like you said, you can't even have an ironing board in that room, so it is quite complicated.
Yeah.
Okay, and then
SARS,
another.
sorry, SARS ask for a photo. We've had so many times that they ask you to submit a photo of it, and they have declined an expense because they could see on the carpet that the bed, you could see that the bed was there, and they actually moved the bed out for the photo. So they go and zoom in on that photo, and they look for every little reason not to allow you to claim that.
Oh wow.
Yeah.
Yo. Another question we got sent in is the person said, I see that I have a tax refund from 2020, but I never claimed it back. How can I claim that back now?
Okay, so if the tax return has already been submitted and the refund is showing on your assessment, you just didn't get the refund back, then either your bank details need to be updated. So it could be that your bank details are invalid with SARS, or maybe your profile is not compliant. So if either of those two is the case, SARS would withhold your refund until you update your bank with them, or you make your profile compliant by submitting any outstanding returns. Yeah. The second one to this is, so I'm not sure exactly what this person's scenario is, so I'm explaining both, is if you notice now that you have a refund but you haven't submitted that to SARS. So you've submitted your return and now you realize, oh, I could have actually claimed another expense, then you can dispute a tax return. So if a return has been submitted and assessed, you can dispute a tax return with SARS, where you then say, okay, I don't agree with this assessment. I actually have this and this income and expenses as well. SARS allows disputes for 3 years after the assessment date of your submission of your the actual return, and they do, in very exceptional circumstances, allow a longer period than 3 years. It has to be very exceptional circumstances. So it's to submit a dispute, it's via e-filing, but it's very complex. It's actually it goes into legal proceedings. So I would definitely say use a tax practitioner to help you with that.
Okay, agreed. And then when it comes to tax-free savings accounts, I also think this is also trading on the investing side as well. But when and for who would you say it would be smart to have a tax-free savings account, since not all people will benefit from having it? And when it comes out of a tax perspective, would you say that it's better to start with your tax-free savings account and max that out, or your retirement annuity? That's also a question that we got here.
Mhm.
Which one to max out first?
Okay, so I would say your tax-free investment, because obviously you get to contribute 36,000 Rand per year in a growth fund. And all the growth that you make on this is going to be tax-free, where anything that you put in your retirement annuity, that is taxable. So that's why I would definitely recommend a tax-free savings first. I personally am not a fan of retirement annuities. I don't feel like the gain is very good, but also because I work with so many people who immigrate from South Africa, so you're very limited when it comes to a retirement annuity. You can only withdraw this at the age of 55 or whatever your policy's maturity rules are. So it's quite stuck in that status. You know, you have to leave it there until you can mature one day. But if you immigrate, there's also a limitation on it that you have to actually wait for 3 years after being a non-resident, for 3 consecutive years before you can actually access your money. So it just feels to me that it's quite limited in terms of what you of your access to that. But just to come back to the tax-free investment, is that it can be very beneficial if you do keep it long term, because obviously there's a limit that you can put into it, 36,000 a year and maximum 500,000 Rand. So it's not a lot, but if you think about this over the long term, 10 years, 20 years, your growth on that will be quite a lot, and it would be tax free. So that's why I think it is quite a nice benefit to have.
I'm definitely realizing now that I'm, not maxing that out. So I think I should reevaluate my options as well. So thank you.
Great.
Okay, and then you've mentioned a lot of tips already for the average South African, but is there anything else for the average South African citizen that you would that you could maybe give as a tip?
So citizen is basically, I think, also misconception that can happen here, and I hear it a lot, especially with people who immigrate or foreigners who earn income in South Africa, is that being a citizen of South Africa doesn't necessarily mean that you need to pay tax here or that you are a tax resident of South Africa. So citizenship does not equal tax in South Africa, and the same way around, tax residency doesn't necessarily mean citizenship in South Africa. So we are citizens of South Africa. We started working here, and for that reason, we had to register for tax. We are tax residents. But if you leave South Africa and you have no intention of coming back to South Africa, you break tax residency and you don't have to pay tax in South Africa anymore, but you can still remain to be a citizen of South Africa. Then you could also be a foreigner who either comes to spend some time in South Africa and they meet our physical presence test, or maybe they bought a property here, and they earn income on that. Then they have a tax obligation in South Africa. So then in that case, they're a citizen, but they have a tax obligation, so they become a taxpayer in South Africa. So just maybe to understand that part of citizenship, that it doesn't equal tax.
A very important one. And I think I've had that conversation with quite a few friends who immigrated. And I think there was still some confusion. So hopefully they listen to this part as well.
Mhm.
Okay. Then another question from a listener that I got. My company already did all my tax stuff, so I have nothing to do. This was the comment from the person. What would your
Mhm.
advice for such a person be? Do they really have nothing to do if the company did all their tax stuff?
Yeah, we get this quite a lot as well. And the answer to this is, if your company did not provide you with an IT12 return and an IT34 assessment, they did not submit your tax, or they did not provide SARS with your tax at all. So generally, what your company does, it's their obligation. It's like our obligation is to submit our tax returns. A company's obligation is to submit an RP5 reconciliation to SARS annually, where they say to SARS, these are all our employees, this was their salary, and this is the pay as you earn that I deducted from their salary. that's what your company submits to SARS, your IRP5. Your IRP5 then gets loaded to your e-filing profile, and it's still your obligation to submit your tax return. So unless they've provided you with a tax return and an assessment, they have not submitted your tax. And if you are not submitting your tax, you're going to have penalties for late submission of tax returns. So my advice in this is that every individual should have their own e-filing profile to at all times know what's going on their SARS and with all their SARS affairs. And secondly, if you don't want to do this by yourself, then definitely get a tax practitioner to help you, but your company is not going to do it for you.
Okay, I think that answers a lot of new workers and a lot
Yeah.
of people that started working recently. Okay, and then this is a very popular question that I got from a lot of people. Any general tax tips for homeowners?
Yes, so there's quite a lot. Okay, so if you own a property where you live in, then unfortunately you don't get to deduct any of your expenses from your income. But you do have a few things that you need to do. So it's very important, and this is actually quite shocking that I think conveyancers should inform people of this fact is that when you sell your property in the future, you're going to pay capital gains tax on the sale of this property. And again, to my first point, is that always make sure that you keep accurate records. So when you sell this property in the future, you're going to have a selling price, and you then get to deduct from that all the costs that you paid to purchase this property. But again, the burden of proof is on the taxpayer. So you need to provide the purchase price that you paid on this property. So that would be generally your offer to purchase on the property. Then if you paid transfer cost to the attorneys, transfer duty to SARS, and any improvements that you do on this property. So once you start doing renovations, put a little folder on your computer, and everything that you pay in terms of this renovations, pop their invoice there, pop their proof of payment in that folder, and keep a spreadsheet to say, this was all the expenses. And this is probably the one that a lot of people are not able to provide the proof for. So definitely keep track of all of those expenses, because this will reduce your capital gains that you pay in the future. Nobody wants to pay more capital gains than they need to. So, if this is your property where you live, it's your primary residence, you get a primary residence exemption of 2 million Rand on the sale of that property. So, it's important to note it's per property. So, if you own it 50-50, then you get 50% of the 2 million Rand. So you'll have your gain, and then you get to deduct 1 million Rand from that before the tax is actually calculated on that. So that's if it's your personal home where you live. Then if you have a property it's your investment property, you rent it out, then you don't get the 2 million Rand exemption that you get when it's your own personal property, because this was trade income, so it's basically a business that you have. So you don't get that, but everything else applies. Keep the same documents, the same capital gains tax implications are going to arise when you actually sell this property in the future. The benefit that you have to this one is obviously you earn rental income on this property, so you get to deduct your expenses relating to this property. So it's important then to keep that. And then in terms of repairs and maintenance, you get to deduct off of this property. So repairs and maintenance is if you fix anything on your property. And improvements that I just mentioned that you get to deduct from your capital gains is if you had renovations. So improvements would be anything that you do to increase the value of your property. So in the future, you'll be able to sell this at a higher price because you've done all these beautiful renovations to it. So how you make a distinction between the two is that repairs and maintenance means that you had to fix something. So let's take an example of your kitchen. You decide that you don't like what this kitchen looks like anymore, it's ugly, you want to make it pretty now, and you do all these renovations on it. That is the sole purpose of that, was to increase the value of your property, and for that reason it's capital in nature, so you can deduct those expenses from the future sale of your property. But the repairs and maintenance would be if, for example, the geyser burst in your kitchen and it ruined all your cupboards and it ruined the tiles, and the kitchen is not usable anymore for that reason, and you need to spend all this money on fixing the kitchen. That is repairs, so that can then be deducted from the rental income that you get on this property. So that's important to know the difference on those two. Then the kind of expenses that you can deduct from your rental income is your levies, rates and taxes, if you pay property insurance, security, the finance charges on your bond. So a lot of people also think that my bond is 20,000 Rand a month. I get to deduct that whole bond. It's not the full bond, it's the finance charges only. But luckily, that's the biggest part of the bond. So you do get to deduct that biggest portion of the finance charges. So there's a benefit of paying finance charges sometimes. And whatever else you pay for this property, maybe you have some unique things that you pay for your property, you get to deduct your expenses from that. Then, in terms of properties, if you want to build up a property portfolio, then I would always suggest do not purchase this property portfolio in your personal capacity, because again, our tax rate is between 18 to 45%, which means that you maybe earn a salary already and you've got all these properties with all this rental income coming in. You can very easily find yourself in the 45% tax bracket, which is just totally unnecessary. And also, again, you're sitting with all this personal assets in your personal capacity. So if you pass away one day, then estate duty tax is payable. So if you're wanting to create this property portfolio, then it's important to have a structure for that. So I'd always go for the family trust, because of succession planning, and your family trust would then, you would be the beneficiary of this family trust, so that you can reap the benefits of whatever this trust owns of your assets, right? And this family trust would then own a company, and the company, so that basically the trust would be the shareholder of the company, and the company would own the properties, all these properties that you buy. And the reason for that is because the company pays 27% flat rate tax, whereas the trust is going to pay 45%. So you don't ever want to put your income bearing assets in a trust. A trust does have another function where you can do the conduit principle, where if you have your assets in your trust and you have beneficiaries in your trust, the individual beneficiaries, you can do the flow through principle, where you say, okay, this trust owns 10 properties and this is the rental income. Let's say all the beneficiaries are earning the rental income. That's a benefit that a trust has. So if the trust then says they distribute all this income to the beneficiaries, we as the beneficiaries again will pay 18 to 45% tax. So again, that's why it's not feasible to put it in the trust, because you might end up at your 45% tax bracket again, where if it's in the company, it's 27%. The trust ultimately still owns this property because the trust owns the company. So that's just the way you set up your property portfolio if you are thinking of buying a lot of properties. Then a last little tip in terms of if you have rental properties, and let's say you do have this in the company, you always want to reduce your profit. Otherwise, you're going to pay 27% on all your rental income. So a very good tip in terms of that is that if you have tenants living in your property, have it bonded, because your tenants are paying that finance charges. So you basically get this property for free. And secondly, you get to deduct all that finance charges from your tax. So it's just a win-win situation. So if you do want to have this property portfolio company and you do want to maximize your benefits from that, then this is also a very good option to have. Don't buy cash properties, because you're putting all your cash into these properties where you're going to pay a high tax. Rather, let the tenants pay the finance charges and pay this all for you, and put your capital in another asset where you are growing that income.
I think your answers, like each question that I ask and like how you answer it, just makes me realize why I have you as a tax advisor. And even I work in the financial industry, but I feel like this is a lot of information, and you know, situations change so quickly, and that means your tax changes so quickly. So having that expertise is really important, especially for these nitty gritty, like when you start buying property, and there's a lot of deductions that you can actually get that you're not aware of.
Yes, absolutely. So that's why it's so important to have someone that you can go to for this information.
And then this is, I think, more towards small businesses. But what are some taxable deductions and benefits from owning a business?
Okay, so I'm assuming we are talking about owning a business in your personal capacity. So you're a freelancer or sole proprietor. So you get to deduct basically anything that it takes to run this business. So I think we touched on it just now when you asked the home office expense question. Is the rent, electricity, cleaning, all of that, the portion of your house. And then you get to deduct your cell phone cost, Wi-Fi cost, any stationery that you buy or meetings that you have with your clients. And then you get to deduct wear and tear. So this is, I think people know this more as depreciation. So, if you have a computer or a cell phone or a car that you use for business purposes, you get to deduct a certain percentage of the cost of that asset from your tax. So, for example, a car, if you use that for business, then you get to deduct 20% of the value of this car from your taxable income that year. So, that reduces your tax, obviously. A computer and a cell phone is 33% per year that you can take the value of that and you can deduct that as an expense. It's just also very important to know that when you sell this asset in the future, SARS wants that money back. So if you deducted all this wear and tear from your car and you sell this car, they're going to recoup a certain percentage of that. It won't be the full amount, but a certain percentage of that. But it's not necessarily such a bad thing because in that same year, you would have bought another car and you get the wear and tear deduction again in that year. So it is a very nice tax planning tool to use as well. And then your fuel that you use for business purposes, and basically just anything that you do to run that business.
Okay. I see there's no more questions, but I feel like this live was quite informational. And if you guys want to, you can watch the live afterwards. But I think, Mariska, because this is a lot of information, if anybody has questions, and you mentioned your email address at the start, but maybe just if you can, yeah, just quote the email address again and where they can contact you guys if they have any tax questions or want to set up a free consultation.
Okay, so my email address is Mariska, and it's spelled Marisca at Mint Accounting, MINT accounting.co.za. We are also on Facebook and LinkedIn and Instagram. I just want to see on LinkedIn, we are Mint Accounting and Tax Advisory. So you can find us there, and we are very responsive. And also, we have a website. So it's www.mintaccounting.co.za. So there's lots of ways that you can get hold of us.
Well, there you have it, guys. And thank you so much for joining us, Mariska. I know that I've already learned a lot. And I mean, I've had a few conversations with you, but I feel like each time that we speak, I learn something new. So thank you so much for this. And yeah, thank you guys for joining. Without you, we wouldn't have the live. So I hope you guys enjoyed it. And if you have more questions, feel free to reach out to Mariska.
Thank you, Chanel. It was very nice to join.
Bye, everyone.
Bye.